In 1933, the US government made it illegal for you to own gold. In 1971, they severed the link between the dollar and gold entirely. For 50 years, the world has lived on paper promises, but in 2026, those promises are finally being called in. Right now, we are witnessing the most significant shift of global wealth in our lifetime. As of May 2026, the smart money is no longer betting on debt. They are betting on the shiny metal. For the first time in 3 decades, central banks hold more value in gold than they do in US Treasuries. But why is this happening now? Why did the gold-oil correlation break in March? And why are banks like JP Morgan suddenly calling for $6,300 an ounce? In this video, we're going to walk through the entire story. From the secret gold sieges of the 1930s to the macro paradox happening on your trading screens today. This is everything you need to know about the 2026 gold stampede. Hi, I'm DJ DomFX and you're watching Edge Trading UK. To truly understand why gold is valued the way it is in today's markets, we have to look at 2 American presidents who completely rewrote the rules of money. One caged gold to save the economy, the other one set it free. In the 1930s, the US was in the depths of the Great Depression. The country was on a strict domestic gold standard, meaning paper dollars could be traded at a bank for actual physical gold. As banks began to fail, terrified citizens started hoarding physical gold, rapidly draining the government's reserves. In April 1933, as a newly appointed president and as one of his first acts in power, President Franklin D. Roosevelt declared it a federal crime for private citizens to hold significant amounts of gold coins or bullion.
This nation will endure as it has endured. We will find and will prosper. So first of all, let me assert my firm belief that the only thing we have to fear is fear itself.
Americans were forced to sell their personal gold to the Federal Reserve at the official rate of $20.67 per ounce. Once the government had successfully collected the nation's physical gold, Roosevelt signed the Gold Reserve Act of 1934. He immediately raised the official price of gold to $35 per ounce. By unilaterally increasing the dollar price of gold, Roosevelt devalued the US dollar by about 41%. This allowed the government to print more paper money to stimulate the economy and fight deflation. He basically made gold a captive asset of the US government. Fast forward to the post-World War II era. The US dollar had become the world's reserve currency, pegged to gold at Franklin D. Roosevelt's rate of $35 an ounce. The Bretton Woods system was a global monetary order established in 1944 to ensure financial stability after World War II. It created a gold exchange standard where the 44 participating nations pegged their own currencies to gold indirectly through the US dollars, and they agreed to keep their exchange rates within a narrow 1% band of this fixed value. While American citizens couldn't trade their paper money for gold, foreign governments still could. As global trade grew, the world needed more dollars. However, the more dollars the US printed, the less gold it had to back them. By 1971, US gold reserves had plummeted while foreign dollar holdings surged due to Vietnam War spending and trade deficits. Foreign nations realised that the US had far more paper dollars circulating globally than it had actual gold in Fort Knox, and they began demanding their physical gold back. On August 15, 1971, in a surprise televised address, President Richard Nixon announced he was temporarily suspending the ability of foreign governments to convert their dollars into gold.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
This action severed the final physical link between the US dollar and gold. It ended the gold standard entirely and created the modern era of fiat money, currencies backed only by government decree and public trust. Gold was suddenly set free to be priced by the open market, freed from its artificial $35 peg, and as a result, gold's value skyrocketed throughout the 1970s, transforming it from a static reference point for currencies into the volatile, freely traded safe haven asset traders use today. After Nixon cut the link to gold, the US struck a new deal to ensure oil was priced only in dollars, creating a new kind of gold for the global economy. Knowing how gold moves is essential for any trader's technical and fundamental analysis. In simple terms, when gold is in demand, the price will increase as market movers, i.e. financial institutions, are willing to pay more to acquire it. Price will decrease if other opportunities elsewhere in the financial markets offer greater rewards and they're selling gold to fund those contracts and cover margins. So let's dive deeper into the rabbit hole. Following Nixon's address in 1971, gold is not a liability of any government or corporation. When you buy gold, you own gold, but you don't receive interest or dividends for owning it. Gold is always valued at the open market price. Opportunity cost is a profit you miss out on by choosing one investment over another. Since gold doesn't pay you anything to own it, it is a non-yielding asset. Here is how that cost goes up. Imagine you have $2,000. You have two main choices. Option A, you buy gold, it just sits there and you hope the price goes up, but you earn nothing in interest. Option B, you put it in a high interest savings account or buy a government bond. When interest rates are low, your opportunity is low. If a bank account pays only 0.5% interest, you aren't missing out on much by holding gold. The cost of choosing gold over the bank is tiny. This makes gold very attractive. Now let's flip the coin. When central banks like the Fed raise interest rates, say to 5% or 6%, the maths changes. By holding gold, you are now giving up the guaranteed 6% return you could be earning in a bond or bank account. That 6% is your opportunity cost. A clear, real-world example occurred during the 2022 Federal Reserve rate hike cycle. In response to record-high inflation, the Fed launched one of its most aggressive series of interest rate increases in history. In early 2022, gold prices soared near an all-time high of $2,050 an ounce due to the onset of the war in Ukraine. From March 2022 to the end of the year, the Fed rapidly raised interest rates from 0.5% to 4.5%. As interest rates and the yields on government bonds rose, the opportunity cost of holding gold became too high for many investors. They could now earn a guaranteed 4.5% interest on cash or bonds instead of zero on gold. Consequently, gold prices tumbled nearly 20%, hitting a low of around $1,615 an ounce by September 2022. This example shows that even during a global conflict, which normally drives gold up, a massive jump in opportunity cost can be a stronger force, pulling gold prices down as investors chase higher yielding alternatives. As of early 2026, we can look back at the 2024-25 cycle as a textbook example of how falling rates act as rocket fuel for gold. In September 2024, the Fed delivered its first rate cut of the cycle. Unlike 2022, where rising rates pushed gold down, the falling rates of 24-25 pushed gold into a historic bull run. Gold prices climbed from roughly $2,500 an ounce in mid-2024 to over $4,000 an ounce by late 2025, a massive 64% annual gain, its strongest performance since 1979. The cost of holding gold essentially vanished during this period for two reasons. As bond yields dropped towards 3.5%, investors no longer felt they were missing out on high guaranteed returns by holding gold. Lower interest rates typically weaken the US dollar. Because gold is priced in dollars, a weaker dollar makes gold cheaper for international buyers, further driving up demand. In early March 2026, we witnessed what economists call a macro paradox. Usually, gold and oil move together. If oil goes up, inflation goes up, and people buy gold to protect their wealth. But earlier this year, that relationship broke. When Brent crude surged past $120 per barrel following the closure of the Straits of Hormuz, it didn't act as a signal to buy gold. Instead, it acted as a signal that the Federal Reserve was about to get aggressive. The market read high oil as sticky inflation. Investors panicked, thinking if energy costs are this high, the Fed will have to keep interest rates at 3.75% or higher for years. This created a massive opportunity cost. Gold pays you nothing to hold it, but a US bond was paying nearly 4%. Traders sold their dead gold to chase those live yields. This is why we saw gold slip below the $5,000 psychological floor in mid-March, even though the world felt like it was on the brink of conflict. Everything changed on the 17th of April 2026. With the Strait of Hormuz reopened and oil plunging 10% to the $88 range, the inflationary trigger had been pulled out of the market. Suddenly, the Fed didn't look so hawkish. The bearish pressure on gold had evaporated, allowing it to reclaim that $5,000 psychological level. And here is the smoking gun for this move. While retail traders were worried about oil prices, central banks were executing the Great Flip. For the first time in 30 years, the total value of global gold reserves has overtaken US Treasuries. Think about that. The world's biggest money managers now trust the yellow metal more than the debt of the world's largest superpower. This isn't a unified market. We're currently seeing a battle between tactical survivalists and strategic architects. Let's talk about Turkey. They are the ultimate tactical sellers. When oil hit $120 per barrel, Turkey, a massive energy importer, saw its currency, the lira, begin to collapse. They didn't have time to wait for a rally. They treated their gold as a high-speed ATM, swapping roughly 60 tons through the Bank of England to get instant cash to save their economy. Russia is in a similar boat, liquidating gold to fund internal war efforts. To these nations, gold is a war chest to be spent in a crisis. On the other side, you have the architects. The People's Bank of China isn't buying for a quick flip. They're building a sanction-proof economy. With 18 straight months of buying, China is signalling to the world that the petrodollar era is ending. Then there's Poland. The National Bank of Poland has become the gold lion of Europe. They've moved their gold from London back to Warsaw and are buying at a pace that has now surpassed the UK's total reserves. Why? Because they want to reach a Western level of stability where gold makes up 20% of their total reserves. This creates a zero-seller environment. Even when Turkey sells 60 tonnes, China and Poland are there to scoop it up at a discount. This is why the $4,800 level acted as such a rock-solid floor last month. Every time the price dipped, a whale was there to buy it. So where does the smart money see us on December the 31st? Most major banks have transitioned from cautious observers to structural bulls. Even after the volatile start to 2026, the consensus hasn't flinched and they are looking right through the noise. These guys are the biggest bulls on the street right now. JP Morgan recently raised their target to $6,300 an ounce, and Wells Fargo joined them at that same level. Their logic? It's a structural demand thesis. They aren't just watching inflation, they are watching the debasement trade. With the US national debt nearing $39 trillion, the inflation tax is becoming a primary driver for retail investors. They expect a massive wave of ETF and physical bond demand to fuel the retail stampede as people realise their cash is losing its footing. UBS is slightly more tactical, projecting gold to hit $6,200 an ounce mid-year before potentially settling at $5,900 an ounce by year-end. They flagged an extreme upside scenario of $7,200 an ounce if geopolitical tensions in the Middle East escalate further. Goldman Sachs remains a conservative voice at $5,400 an ounce, but don't let that number fool you. They call gold their highest conviction long. Their target is underpinned by relentless central bank buying, averaging at around 60 tonnes a month, and being driven by emerging markets aggressively diversifying away from the US dollar. Now, if $5,000 or $6,000 an ounce sounds like a bubble to you, we need to put it into historical perspective. Let's look back at the legendary January 1980 peak. Back then, gold hit a nominal high of $850 an ounce. On the surface, that looks small compared to today. But when you adjust that for 46 years of inflation, that 1980 peak is equivalent to roughly $3,400 an ounce in today's dollars. Here is the kicker. For over 4 decades, gold never actually broke that real all-time high until late last year. When we smashed through $3,500 an ounce in 2025, we didn't just hit a new number. We ended a 46-year period of real-term consolidation. But there's a massive difference this time. In 1980, central banks were the biggest sellers, actively trying to suppress the price. In 2026, central banks are the biggest buyers, accumulating bullion at a record-breaking pace of roughly 60 tonnes a month to diversify away from the dollar. We aren't just repeating history, we are seeing a structural shift that the 1980s investors could only dream of. We aren't at the end of a bubble, we are in a new era of price discovery. If you're trading this rebound, these are your 3 mission-critical zones to watch. The iron floor stands around $4,400 to $4,600 an ounce. This is our primary safety net. It held firm during the sharp March correction and proves that the floor is rising far above those old inflation-adjusted levels. The pivot point is the $5,000 level. When price climbs back above the psychological $5,000 mark, this is a launch pad for the next leg higher. And the kill zone is $5,608 an ounce. This is the all-time high set in late January. A weekly close above these levels likely triggers a massive run towards a $6,000 milestone. Remember, the pros didn't see the March dip as a crash. They saw it as a tactical correction in a volatile bull market. The trend is your friend, and right now that trend is backed by central banks that show no sign of stopping their gold rush. Gold remains the ultimate safe haven because it has zero counterparty risk. In a world of $39 trillion US debt, gold doesn't rely on the government's promise to pay. Whether gold hits $6,300 an ounce by Christmas depends on one thing: the world's continued move towards real assets over paper promises. The history is fascinating, but the current data is undeniable. When you see nations like Poland and China aggressively hoarding physical metal, while the US debt climbs towards $39 trillion, the message is clear. The world is moving towards real assets. We've looked at the iron floor at $4,400 an ounce, and that massive kill zone target of $5,608 an ounce. Whether we hit that $6,300 rally by Christmas depends on how much trust is left in the system. But I want to hear from you. We've seen the survivalists like Turkey selling and the architects like China buying. Which side are you on? Are you holding for the $6,300 moonshot? Or do you think this 2026 rally has run its course? Drop me your price predictions in the comments. I'll be down there responding to as many as I can. If you found this deep dive helpful, hit that like button and subscribe to Edge Trading UK. It's the best way to stay ahead of these global shifts before they hit the headlines. I'm DJ Dom FX. Thanks for watching, and I'll see you in the next one.